Redwire, trading under the ticker RDW, is one of the most interesting and most volatile companies in the space and defense technology sector. Its revenue is growing rapidly, analysts see significant upside, and the acquisition of Edge Autonomy has transformed the business. But Redwire is also reporting heavy operating losses, negative cash flow, and continued shareholder dilution. The real question is whether its financial performance is strong enough to justify the risk. Before examining the financials, let us quickly understand what Redwire actually does. Redwire does not primarily launch rockets. Instead, it supplies many of the systems that spacecraft, satellites, and military drones need to operate. Its products include complete satellite platforms, rollout solar arrays, docking systems, navigation sensors, onboard computers, and military communications payloads. Following the acquisition of Edge Autonomy, Redwire also sells Stalker and Penguin surveillance drones, along with Octopus camera systems. The company generates revenue through hardware sales, government development contracts, engineering and integration services, mission support, and microgravity research aboard the International Space Station. Redwire's revenue growth has been impressive. Trailing 12-month revenue reached around $371 million as of March 2026, representing year-over-year growth of 34%. Revenue has grown at an annual rate of about 40% during the past 5 years, while analysts expect growth of close to 26% annually over the next 3 years. Historical revenue increased from $138 million in 2021 to $335 million in 2025. The current analyst estimate suggests that revenue could reach about $469 million in 2026. Revenue could approach $739 million by 2028. The composition of that revenue has also changed significantly. In 2025, space segment revenue declined by about 18%, from $255 million to $210 million. In contrast, defense tech revenue increased by roughly 157%, rising from $49 million to $126 million. Defense tech therefore represented about 37% of total revenue in 2025, compared with only 16% 1 year earlier. The main reason was the Edge Autonomy acquisition. Redwire reported that Edge contributed about $107 million of defense tech revenue after the acquisition was completed in June 2025. This means Redwire is no longer simply a space infrastructure company. It is increasingly becoming a combined space and defense technology business. If you're getting value from this analysis, subscribe to the channel for more detailed stock breakdowns. What are the main revenue-generating products? Within the space segment, the first major activity is building complete spacecraft. Redwire supplies satellite platforms such as SabreSat, Phantom, Thresher, Mako, and Hammerhead. Revenue is generated through long-term contracts covering spacecraft design, manufacturing, payload integration, testing, and mission support for government and commercial customers. The second major space activity is supplying the infrastructure that allows spacecraft to operate. Redwire manufactures rollout solar arrays that generate electricity in orbit, along with docking mechanisms, power systems, and other critical spacecraft components. Customers can purchase these systems even when another company is building the overall satellite. Within defense tech, the largest identifiable activity is the sale of Stalker and Penguin uncrewed aircraft. These drones are used by the U.S. military and allied governments for long-duration surveillance, reconnaissance, and target monitoring. Redwire earns revenue from aircraft deliveries, ground control systems, integrated cameras, training, replacement parts, and ongoing mission support. The second major defense tech activity is supplying sensors and communications equipment. These products include stabilized Octopus camera systems for daytime and infrared surveillance, along with radio frequency payloads that transmit secure military information. Redwire can sell these systems separately or integrate them into its own drones and satellite platforms. Strong revenue growth has not yet translated into consistent profitability. Over the trailing 12 months, Redwire generated gross profit of about $48 million, with a gross margin of only 12.9%. Its operating loss was around $219 million, producing a deeply negative operating margin of about 59%. So, although Redwire is expanding revenue, it has not yet demonstrated that it can convert that growth into sustainable operating profits. The segment results show how quickly the financial picture deteriorated. In 2023, the space segment generated operating income of $27.6 million, while defense tech generated $9.2 million. Both segments were still profitable in 2024, although their operating income declined. But in 2025, space reported an operating loss of $49.2 million, while defense tech reported a much larger loss of $93.6 million. On a trailing 12-month basis, the losses increased further to $56.4 million for space and $142.2 million for defense. It is important to understand that Edge Autonomy itself was profitable before Redwire acquired it. Edge generated about $26 million of operating income in 2024. However, after the acquisition, Redwire's defense tech results were affected by acquisition-related compensation, purchase accounting adjustments, amortization, and other costs. So the acquired operating business may be profitable underneath, but the consolidated defense tech segment has not yet demonstrated sustainable reported profitability. For 2026, Redwire expects revenue of between $450 million and $500 million, compared with 2025 revenue of $335 million. That represents growth of between 34% and 49%. However, management has not provided full-year guidance for net income, operating income, or free cash flow. Therefore, the company has not officially promised that its losses will decline. The first quarter results look particularly weak on the surface. Redwire reported a net loss of $76.5 million. However, more than $44 million of the reported loss came from mainly non-recurring items. The largest component was a final $42.5 million accelerated stock compensation charge connected with Edge Autonomy. The consolidated company remained negative because of corporate expenses and other centrally retained costs. Redwire's cash flow history shows that the company has not yet developed a consistently self-funding business. In 2021 and 2022, free cash flow was negative by between $35 million and $39 million. Performance weakened again in 2024 and deteriorated dramatically in 2025. Operating cash flow fell to negative $177 million, while free cash flow reached negative $191 million. Importantly, capital expenditure was only about $13.5 million. This means most of the cash burn came from operations and working capital requirements, not from major investment in factories or equipment. The latest trailing 12-month figures show some improvement. This was largely because Q1 2026 operating cash outflow was only $6.7 million, compared with more than $45 million in Q1 2025. So the direction improved, but Redwire is still consuming significant cash. Until operating cash flow becomes sustainably positive, the company may continue depending on share issuance, existing cash reserves, or additional borrowing. Redwire's balance sheet looks more liquid than before, but the source of that improvement is important. Cash increased from $95 million at the end of 2025 to $145 million by March 2026. Current assets were $321 million compared with current liabilities of $183 million. This produced a current ratio of 1.75, indicating a reasonably comfortable short-term liquidity position. Total debt, net of discounts and issuance costs, was about $88 million. Because cash exceeded conventional debt, Redwire ended the quarter with a net cash position of around $57 million. The company also refinanced its $90 million term loan and extended the maturity to 2029. So immediate liquidity risk appears manageable. However, the business still consumed cash during the quarter. The main concern is that much of the cash improvement came from issuing additional shares. Redwire issued 6.94 million shares through its at-the-market facility and raised about $63.5 million. Outstanding shares increased from 191.9 million at the end of 2025 to 198.9 million by March 2026. That represents an increase of 7 million shares, or 3.6% dilution, in just one quarter. This means the company's liquidity improved, but existing shareholders owned a smaller percentage of the business. Redwire also had convertible preferred stock with a liquidation preference of about $137 million. This sits ahead of common shareholders and represents an additional financing overhang beyond regular debt. On the positive side, extending the term loan maturity to 2029 reduced near-term refinancing risk. The company also obtained access to a revolving facility of up to $30 million. But unless operating cash flow improves, Redwire may continue relying on external financing. Another important issue is the quality of Redwire's reported assets. The company had total assets of about $1.51 billion. Of that amount, $776 million was goodwill, and another $327 million was intangible assets. Combined, goodwill and intangible assets represented 73% of total assets. These balances were created mainly through Edge Autonomy and Redwire's earlier acquisitions. If those businesses underperform, Redwire could eventually be required to record an impairment charge. After removing goodwill and intangible assets, the company's tangible equity cushion is very limited. Deferred revenue of about $80 million is a modest positive signal because it represents customer payments received before the related revenue has been recognized. Overall, the balance sheet provides enough near-term liquidity, but it remains heavily dependent on equity issuance and the successful performance of acquired businesses. Redwire currently has a market capitalization of around $2 billion. Based on trailing revenue of $371 million, the stock trades at roughly 5.3 times sales. Using management's 2026 revenue guidance of $450 million to $500 million, the forward price-to-sales ratio falls to between 4 and 4.4 times. Compared with other loss-making space companies, Redwire appears relatively inexpensive. Intuitive Machines trades at about 8.6 times sales, Black Sky at around 9.2 times, Planet Labs at more than 22 times, and Rocket Lab at over 60 times sales. Redwire therefore trades at the lowest price-to-sales multiple within this peer group. But a lower multiple does not automatically mean the stock is undervalued. Redwire also has weaker historical margins, substantial operating losses, negative free cash flow, and continued dilution. So the lower valuation may represent an opportunity, but it may also reflect the company's higher execution risk. At the current valuation, the stock could become attractive if revenue reaches the upper end of guidance, margins continue improving, and dilution slows. Redwire's 2-year chart shows just how volatile the stock has been. The first major rally took the share price from $6.68 to around $25.50 by February 2025. That was a gain of 282%. But the stock then collapsed to around $7.60, representing a decline of 70%. It later recovered to about $20.50, delivering another gain of 170%. However, by November 2025, it had fallen to nearly $5, a decline of 76% from the peak. By February 2026, Redwire climbed back to around $14, gaining 180% from its previous low. But the momentum again faded, and the stock declined 45% to around $7.70. Most recently, the stock surged from around $8.50 to $25.80 by June 2026, a gain of more than 200%. It has since declined by roughly 68% and is now trading near $8.30. So during the past 2 years, Redwire has experienced 4 major declines, ranging from 45% to 76%. Its rallies have repeatedly failed to create a stable and sustained upward trend. The latest surge may have been supported by excitement surrounding SpaceX and the broader space sector. But Redwire has repeatedly found new reasons to double or triple before eventually losing momentum. This makes the stock attractive to speculative traders, but extremely risky for investors who enter near the peak. Before we look at analyst price targets, a quick disclaimer. This video is not financial advice. Analysts remain broadly bullish on Redwire. Stock Analysis reports an average 12-month price target of $14.88, representing upside of about 75% from the share price used in this analysis. Its most optimistic analyst target is $24, which would imply upside of around 183%. Market Beat reports an average target of $15.40, representing potential upside of about 82%. TipRanks is even more optimistic, with an average price target of $17.60, implying potential upside of around 108%. Across these 3 platforms, the average targets range from roughly $15 to $18. However, price targets are not guarantees. Their accuracy depends on Redwire achieving its revenue forecasts, successfully integrating Edge Autonomy, improving margins, and progressing toward positive cash flow. Final verdict. To briefly recap, Redwire has several attractive qualities. Revenue is growing rapidly. Defense tech has become a much larger part of the business. Management expects another strong year in 2026, and the stock trades at a lower price-to-sales multiple than several major space sector peers. The company also has enough liquidity to meet its near-term obligations, and Edge Autonomy gives Redwire exposure to military drones and surveillance systems. But the risks remain substantial. Redwire is still reporting major operating losses. Trailing free cash flow remains negative by more than $150 million. The company continues issuing shares, and 73% of its assets consist of goodwill and intangible assets. The stock's trading history also shows that even after doubling or tripling, it has repeatedly suffered declines of between 45% and 76%. For me, Redwire is not a buy at this stage. I think the stock will remain speculative unless the company begins generating sustainable profits and positive operating cash flow. Revenue growth alone is not enough. I would want to see improving operating margins, declining cash burn, and much less dependence on shareholder dilution before treating Redwire as a long-term investment rather than a speculative trade. If this analysis helped you understand Redwire, please like the video.